Hello everybody, Morgan Kristen, Spinnaker Investment Group. Thanks for clicking on our video. Today we're going to be talking about 2021, what the markets did, what the economy did, and some of our thoughts as we go into 2022. So last year was actually quite a good year. As you see on this chart here, the S&P 500 did double-digit returns in the 20s. Then you had small caps, about 14%. International also did well, about 11%. Emerging markets, not as great. They had a negative year. Then also U.S. bonds. It's been a bit, but because interest rates moved up, bonds actually went down a bit. And then we had Treasury inflation bonds. They actually did quite well because a lot of people are anticipating inflation, and they had a good year at about 6%. High yield bonds also did well, but international developed bonds, again, an interest rate play there. They lost a little bit of value there. And commodities, mainly because of the energy side of the market did quite well. And then REITs, also an inflation play, had a nice year. And then you can also see here the 3, 5, and 10 years. So overall things have held up well, other than commodities over time. Commodities haven't been the greatest thing over the last 10 years, even though they had a very, very good 2021. So we're looking across the world and the markets, and a lot of things happened. We had Bitcoin hitting 50, then it got into the 60s. Small caps topping large caps, so a lot of things went on, but a pretty, albeit a somewhat bumpy year at times, but pretty nice move forward. So we look at U.S. stocks, and again, we just went through looking at the S&P 500, but you can see at the top, large growth really is the dominant sector, and that's mainly been driven by technology. So the 1 year, the 3 year, the 5 year, and the 10 year, 10 years really bested the large cap value stocks. Now we're starting to see some rotation out of the growth into value, but at least for the last 10 years and last year, growth did actually quite well, followed by the very further down the small caps. But it's definitely been a larger technology-driven run over the last few years, and now in 2022 we're seeing that slow a bit, but certainly some tremendous growth in the book. International, pretty much the same story. You had your growth besting a lot of the other areas, but we did have value do quite well against growth internationally, and actually small caps over the 10 year did a little bit better, but somewhat of the same story when you look in the 3 and 5 years, but a little more evenly dispersed in the international markets than the U.S. The U.S. has definitely been dominated by big technology companies. Emerging markets, we had small cap, the little guys actually did quite well. People were willing to take on risks. They went to the emerging markets, and they also bought smaller companies. So people really took the risk on and did well there. And large, actually, and growth did not do as well, interestingly enough, when you look in the emerging markets. Fixed income, we look at the chart here, and you see in 2020, you saw the rates were pretty flat. They were very low in the short end, and we saw a little bit of bump as we went to last year, really on the short end of the curve, that 1 year part of the curve, 1, 2 years, and that is in anticipation of the Fed bumping rates, and we'll talk about that a bit later. But if you look at this chart here, you can see we the U.S., our rates actually look okay comparatively. When you look in the UK, Germany still has some negative yields out to about 10 years. Japan also negative to zero yields for some time. Canada looks much like ours, as does Australia. But again, very low rates, but as pitiful as ours are, ours look better than some. So that's the interest rate world right now, and really you can see by this chart on the left there, though, that the Fed anticipation of what the Fed is doing is really pushing up those rates on the short-term curve. So a lot of that has moved, and maybe you see that in your CDs and or money markets right now. They haven't jumped a lot, but certainly they've moved up a bit. So let's talk about the economy. So last year we had Delta, and Delta was supposed to come to an end, and we'd move out of COVID and all that, and in came the rest of the Greeks. All of a sudden this year comes, and Omicron, boom. Omicron wave comes, and we look at that chart there, and here we go. Out of Delta, things are looking better, and then a massive surge in Omicron. very transmissible, but it's less deadly than the others, like we see in South Africa. South Africa was the first to have the Omicron, but it's also one of the first to reverse that. And so you can see the very dramatic rise up and then that pullback. So as we look at our economy, you could see a slowing in January as flights are canceled and people didn't do things. Businesses and consumers weren't out spending money because of this, but we could see that move back up and maybe another push in the economy. Leading economic indicators, not surprisingly, after we opened up a bit last year, they snapped back and they moved up nicely. They are actually still above pre-pandemic levels, so that's some good news there. But a big part of that is the government's been very nice, right? They put a lot of money in people's pockets. When you look at this chart here, this is, before we went into the pandemic, people had actually negative savings, and that's across the board. So the chart looks at people in the top 25% income and the bottom 25% of income. So everyone had negative savings. So now people have moved up. You had the first stimulus check. You see the bottom 25, their savings jumped dramatically, tapered back off. In comes the next stimulus, and then the next. And so folks are sitting on a decent amount of cash right now. And so what are they doing? Well, folks are out spending, right? So we saw a massive surge in the purchasing online, as you'll see in this chart on the left. Now it's kind of gone back to a more normalized rate, but that was a massive move. And then the other chart there, you see the kind of lighter blue and the darker blue, we saw a drop, a pretty big drop in services. People weren't using services as much, but you also had a massive jump in goods. People are out there buying goods. They had all this money in their pocket, the stimulus, and they're out buying goods. And so what did we have? Then we had people looking for goods, we had supply chain issues, and of course we had some inflation that came with that. If you can't find things and there's a demand for that, well, prices start going up, and as did inflation. But also, there's money out there. There's also maybe people not going back to work. As this slide shows, the job market has come back. Jobs offered are right back to where they were pre-pandemic, but there's a lot of people that are no longer in the workforce. Now, some of that is structural. Some folks have decided to retire. You look at a line chart of people and going into retirement, and all of a sudden there's a sudden spike. So some people said, that's it. My house is worth more. My 401k is worth more. I'm out. I'm done. I've retired. But you also have they're thinking 10 to 30 million people that have long haul COVID. So those are also folks that could be structurally out of the employment arena for some time. So we have a disconnect right now. We have more jobs than there are people seeking them. Now, maybe if you could be like Wendy's and offer employees free nugs, maybe we could solve that problem. We'll see if that works out. So let's talk about the markets in 2022. This is what the Fed looks at. So the Fed has a two-pronged approach. They want to look at inflation and full employment. Well, the top part there obviously is spike in inflation, and employment is getting back to better. Labor conditions look pretty good. And so now the talk is, of course, should they raise rates? And are they raising rates? And for what they said, yes, they are. So we're probably looking at 3 rate increases. Some believe it may go up to 4, but at least right now, the way they're talking, it looks like about 3 rate increases as we go into this year. Now, back to that inflation number, if you look at that, a big part of that is energy. So a lot of people are concerned, and that's why they're being very cautious in the way they talk about things, is they don't want to overreach, because if you see energy come down, supply chains get fixed, maybe this inflation isn't as bad as we think. However, wage inflation is certainly here to stay. So this is the Fed's plot. So you see the 10-year Treasury in that dark squiggly line there. So the 10-year Treasury is already adjusting to where the anticipated rates are going. Those orange dots show where rates will be in given years. So as you'll see in 2022, that looks like 0.75. So about 3 rate increases of 25 each. And then in the next couple of years, probably a few more bumps. So that dark blue mountain there is where rates are at currently, and they're at basically the 0 range. So we do anticipate those going up about 3 times to about 0.75, and the market has already adjusted for those. Now, another thing you'll hear about from the Fed is tapering. The Fed put on their balance sheet quite a few bonds. They were buying a lot of bonds, and you'll see even larger amounts than they have in a very long time. There's even larger amounts than they did back in the 07-09 period. So we saw a massive spike in the bond purchasing there, and their balance sheet just absolutely expanded. So when the Fed talks about tapering, yes, they're gonna let some of these bonds mature. However, their balance sheet is so huge that it really doesn't matter that much. They will always have a balance sheet because they always need it for liquidity, but there's plenty of room for the Fed to taper. Then you look at the individual investor, and they're not overly optimistic, so that's good news here. And this chart, really, I should update, and we won't receive it until a couple more weeks, and when the month's end or even the quarter is ended. But these last 2 weeks have probably scared a few investors, but they're not overly optimistic, so that's good news. So as a contrarian, that's a good sign. People aren't overly optimistic. They're not buying everything out there, so they're happy, but they're not going crazy purchasing equities. But you look at stocks, you look at the S&P 500, and this still is of concern. You have basically 25% of the market S&P 500 in 5 stocks. So that's a pretty big number, even worse than it was back in 2000. So really dominated by those big tech companies. And so, like we've seen over the last couple of weeks, interest rates have gone up a bit. That doesn't bode well generally for technology stocks. So we've seen the markets come back, but really there are some stocks that have done actually quite well lately. But those big technology stocks are pulling down markets, especially when the S&P is 25% in those couple technology stocks. And then you look at the NASDAQ, that's all pretty much technology. So that is of concern. But you look at earnings. Earnings look pretty good. So these are the forecasted earnings. So obviously not as good as 2021 as we bounced out of 2020, but you look at 2022's estimates, those are quite good. Those are acceptable earnings for any year. So we look at markets in general and say there's certainly some things out there that are of issue, but at least as far as the company is concerned, these are pretty impressive numbers as far as the earnings. And then you put a lot of these things together, you look at inflation and you look at stocks versus bonds or gold or cash, and historically stocks have done well in inflationary periods. They've actually done better than gold. A lot of people run towards gold, but as we saw in the commodities earlier, gold has not actually been that great of a diversifier, and it hasn't really given you that much of a return. But historically stocks have during inflationary periods. And then I have to talk a bit about Bitcoin. Obviously, people look at that as an alternative. Obviously, there's a potential for appreciation. It can diversify, but it's not regulated. You have some potential for fraud. It's very volatile, as you can see in those charts there. You can lead to losses. And like some folks that are right now suing Kim Kardashian and Floyd Mayweather, there's just coins that are absolutely worthless. That coin lost 97%, and of course, people are not too happy about that. So let's wrap this up. Let's look at our birth to death ratio. Last year, when they did the census, we are actually not adding many people. I think there's only 300,000 people. So we're not having a lot of babies, and if you look over the last 2 years, our mortality rate actually dropped. It dropped 1.5% per year. So we're not living as long. So the death rate spiked a bit, and births are not there also, and then our net migration is down. So what does this mean? Well, you could look at potential inflation in the future. Well, that's less people out there demanding goods and services, so maybe that's not as inflationary, but that's also less people that can also work some of these jobs. What does that mean for future supply chains? So I think this is something that will need to be addressed. However, there's always reasons to sell, right? These are all different things that we heard about Delta, we heard about now Omicron. There's a lot of different reasons to sell, but I will say that as Carlos Slim once said, anyone who's not investing now is missing a tremendous opportunity. So, if you're not in it, you can't move forward. So it's always good to look at your portfolio and talk with your advisor, but again, there's always going to be some type of reason to sell. So let's look in general, markets, economy, and all that. Rates are still low. Yes, they're going up a bit, but they're still extremely low. So the lower the rate, the higher you can keep valuations, and that'll stay for some time. Frankly, the Fed raising rates is actually a good thing. That's saying the economy's strong enough to take it, so you want to see that. You want to see some inflation. Those are all both good things for the economy. Now, is inflation, they've taken off, they're transitory, and Yeah, some parts may be transitory and maybe take a year or two before that goes away, but a lot of this stuff is tied to supply chains, and when those clear up, some of this inflation will go away. So the economy, as we look at it right now, we're looking at about a 4% growth in the GDP, but they anticipate that's very front end loaded. The first half of the year probably will take a good portion of that as it slows down into the second part, and that makes sense, and especially with Omicron and all of that possibly slowing down this first month. So jobs, there's plenty of them out there, and I think one of this, people quitting and a lot of people are getting new jobs at higher pay, so that's good. That's more spendable income. So there are plenty of jobs for people to do. There's a lot of incentives for those folks. Earnings, again, they look pretty good. So those are good things. So what could go wrong? Well, again, jobs. If we don't fill these jobs, that could lead to disruptions and problems in the supply chain. Moratoriums ending, so rent, mortgage, student loans, these are all coming back online here. So people are going to have to start paying those. That takes away from money in people's pockets. Maybe the Fed overreaches. They're always behind the curve a bit, so maybe they go too far. So hopefully that doesn't happen. Supply chain issues. There's still boats off the coast over here, and then of course our next level of COVID. I think there's 9 Greek letters after Omicron. So there could be more. Hopefully this one just spikes and drops back down. But overall, again, like I said, there's always reasons that people believe to not own stocks. But what we're doing in our portfolios right now is we're shortening our maturities and durations in bonds, and we're looking at other areas to hedge that. We have been slowly rotating out of some of the growth and looking at big U.S. companies, dividend stocks, and all that. So overall, we think it'll be a pretty good year for stocks, although it probably won't be as great as 2021. But again, we like some of those markets, and sitting in cash or sitting in bonds really doesn't appeal to us. Thank you all for your time. Again, Morgan Christen with Spinnaker Investment Group, and we look forward to speaking.